bring in our panel. Let's all bring our panel back in. Let's also add Steve Leisman, Bob Pisani, and Rick Santelli to the conversation. Steve, let's start with you and that change in language that Kayla just laid out.
Yeah, Kayla certainly highlighted the most important part right there. And it looks like there's two pieces to it. The first one here, in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and economic developments. So the first part, the part I didn't read, is they want to make sure it's sufficiently restrictive to return policy. So that tells you maybe they have more work to do. But the idea that maybe they're taking into account lags tells you maybe they're going to go slower here. I don't think I would mistake this for saying the Fed is ready to pause. I think it's something that you might digest and say the Fed is aware that it's done an awful lot and doesn't feel it has to do quite as much as it had done in the past. I'm going to take a quick look while I'm talking here at what's happened to Fed fund futures, and they've come down a little bit. We'll see if that holds, but that May contract was trading at 503 for a high, for a peak funds rate. Now it's at 496. So not much of a change, but a little bit of coming off there. The market still is reading this, at least in the initial minutes after the statement came out, as believing the Fed has still considerable work that it will be doing. So maybe a slower pace, but I'm not seeing necessarily a lower peak.
Yeah, and yet it seems to be a slightly different story where equities are concerned right now, Bob Pisani. You got the Dow jumping to a 1% gain now. You got the S&P up 0.75%. The NASDAQ also moving higher, markedly higher as well. I mean, when you look at the equity markets, was it just spring-loaded for any teeny tiny sign, any little bit of hope that anything could be even the slightest bit more dovish than what we have seen previously?
Oh, this is more dovish than I think most people were expecting. I mean, when I called and said, is the Fed going to indicate any kind of pivot, any hint of anything? Not in a statement, maybe in the press release. That was the consensus. But look here. All right, Steve's right. This is not a pivot, but the committee will take into account the cumulative tightening of monetary policy. Hey, that's good enough for the bulls that are out there. Look, we just moved 40, 50 points in the S&P 500. 300 points in the Dow easily on that, and that's close enough. Now, on the press release, in the press conference, maybe he'll talk, more clearly coded words. He'll say two-sided risks or risks of slowing growth, something like that. But this is a fairly nice bone to throw to the bulls right now. I think the problem right now for the market is the job market's not cooperating. These JOLTS report, the ADP stronger, and people are afraid the Friday jobs report is going to be a lot stronger than expected. But look how far we've come here, guys. 3,900 on the S&P 500. We were at 3,550 just a couple of weeks ago. Dollar's a little bit lower. Two-year yields have flattened out a little bit, so it's understandable why the market has rallied. But this has really been very, very impressive right now. The problem for the market now is what else are they going to really say to get the market notably higher? We're already trading nearly 17 times forward earnings with no change in the earnings estimates of about $230 for next year. This is a lot of expectations already built into the market. But right now, this is about as much of a bone you're going to throw to the bulls as anyone would have expected, guys.
Rick Santelli, do you see it the same way? What is the bond market telling you about this language in the Fed statement?
Well, I'll tell you what, we knew it was going to either be a pause, pivot, or continue to punish, the three Ps. But I think they weaseled in a little bit and threw the markets a small bone. Granted, it's maybe the size of a wishbone, but I'm wrong. I didn't think they'd throw any bone. The wording as it was put forth and what I heard from Kayla and Steve, to me, sounds like they gave it a little wiggle room, which explains stocks, and the markets smelled it right. I'm always a big believer in market whispering, and if you look at a two-year yield, it started to creep down. If you looked at the euro and the dollar index, the euro, well, it started to creep up. The dollar index started to creep down. Those are both very telltale signs that we're going to be a little less hawkish than maybe many anticipated. And I think when it comes to what the Fed's going to do, I think that anybody who discusses data dependent, I just don't agree with. I think the Fed, and just based on how their statement reads, they are looking at a spot down the road and they change what that area may be. but truly data dependent just doesn't seem to add up at this time.
Shepard Smith here. Thanks for watching CNBC on YouTube.